Hello, everyone. When we hear the word depreciation, we usually think of a car losing value the moment it's driven off the lot. But in accounting, depreciation means something very different and very specific. The dictionary defines depreciation as a decrease in value, but the accounting definition is the allocation of an asset's cost to an expense over its service life. We aren't trying to guess the asset's market value each year. We are simply spreading its original cost over the periods that it helps us generate revenue. Think of it like this. We incur a large cost to purchase an asset today, and that asset provides benefits for many future periods. Depreciation is a process of matching a portion of that cost to each of those periods. The journal entry each period is a debit to depreciation expense and a credit to a special account called accumulated depreciation. Accumulated depreciation is a contra-asset account, meaning it offsets the asset's cost on the balance sheet. The original cost minus accumulated depreciation gives us the asset's book value. To calculate depreciation, we need to know three things: the asset's service life, its residual value or salvage value, and the depreciation method we're going to use. To illustrate the different methods, we'll use one consistent example. Little King Sandwiches buys a new delivery truck. The cost is $40,000. It has an estimated residual value of $5,000 and an estimated service life of 5 years or 100,000 miles. First up is the straight line method. This is the simplest and most common method. It allocates an equal amount of depreciation to each year. The formula is the asset's cost minus its residual value divided by its service life. For our truck, that's $40,000 minus $5,000 divided by 5 years, which gives us a depreciation expense of $7,000 per year. As you can see in the schedule, each year we record $7,000 in depreciation. Accumulated depreciation grows by $7,000 each year, and the book value decreases by the same amount until it reaches the $5,000 residual value at the end of year 5. Next is the double declining balance method. This is an accelerated method, meaning it records more depreciation in the earlier years of an asset's life. The rate is simply 2 divided by the service life. For a 5-year asset, the rate is 2 divided by 5, which is 40%. Here's the key difference. We multiply the 40% rate by the beginning of year book value, not the depreciable cost. In year 1, we take 40% of the full $40,000 cost for an expense of $16,000. In year 2, we take 40% of the new book value of $24,000, and so on. Now, notice two special rules. First, we ignore the residual value in the initial calculations. Second, we must stop depreciating once the book value reaches the residual value. In year 5, we don't take the full 40%. We only record $184 of depreciation, which is the amount needed to bring the book value down to exactly $5,000. Our final method is activity-based depreciation, also called units of production. This method isn't based on time, but on the asset's use. For our truck, that means miles driven. First, we calculate a depreciation rate per unit, in this case, per mile. The $35,000 depreciable cost divided by 100,000 total expected miles gives us a rate of 0.35 per mile. Then, each year, we simply multiply the number of miles driven by the 0.35 rate. In year 1, the truck was driven 30,000 miles, so the depreciation expense is $10,500. This method perfectly matches the expense to the actual usage of the asset. So, how do these three methods compare? This table shows the annual depreciation for each. Notice that straight line is constant. Double declining balance is high at the beginning and low at the end, and activity-based varies with usage. But here is the most important point. Look at the total. All three methods result in the exact same total depreciation of $35,000 over the asset's life. The only thing that changes is the timing of when that expense is recorded.